Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Not-for-Profit Auditing and Accounting, Fall 2020 Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement, or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to turn it over to one of today's presenters, Adam Bowman, Senior Manager at Moss Adams. Adam?
Thank you very much, and hello to all. Sasha and I are excited to be here with you today to talk through some accounting and audit considerations. For any of you who have attended any of our updates in the past or really any audit and accounting update, this will be a little bit different. Normally, these are focused more on the new accounting standards that are issued and how those will change your accounting for normal operations. Obviously, with 2020 being a little bit of a unique year, there haven't actually been a ton of new standards issued, and so instead we will be focusing a little bit more on how to account for changes to your normal operations. So at the end of the session, hopefully you will be able to summarize and discuss the financial statement disclosures and accounting impacts of changes to organizations as a result of COVID and programs under CARES Act. And then we will spend some time talking through recent and new accounting and audit standards and how those might impact your organizations as well. As far as agenda, we will spend the majority of the time talking about the impact of COVID-19, what that does have on your organizations and walking through that. And then we'll spend probably about the last 15 minutes talking through the other standards and other items that impact you. And if we have time at the very end, we will have some time for Q&A. If there are questions that we don't have time to answer during the session, we will make sure to reach out after the fact. So before we dive into the content, we will start off with our first polling question. Amy?
All right, thank you, Adam. So our first polling question is to get a feel for the audience today, and it is, what type of not-for-profit organization do you represent? A, college, university, B, arts, C, foundation or other grant-making organization, D, health and welfare, community service, E, research institution, or F, other. And we'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit.
Perfect. And while you guys are submitting that as well, I will just reemphasize, if you have any questions, please submit them to the chat, and we'll try to get through those as we go through the presentation. And really, this first question, just trying to get a feel for what our audience is like this morning, and hopefully we have content that will be applicable to you regardless of what answer you choose here.
Okay, here are the responses.
All right, so it looks like we've got a pretty even split. So that is about what we were expecting. And with that, I think we are ready to dive into the content. We will start again with the accounting impact of COVID-19, and we will start specifically with the Paycheck Protection Program loan. I think this is the most common new change here in 2020 that organizations are seeing. I know a lot of entities across industries, across different sizes are getting PPP loans. And so we did want to do a just quick accounting refresher for how those loans should be accounted for. There are two ways that PPP loans can be accounted for, and there is no authoritative guidance dictating one specific way. The AICPA did release a technical question and answer document, basically reiterating that these are the two options that you can account for these. There is no right way. It is really up to you as an organization to decide. The first way is just accounting for it as any other debt. So in essence and in form, it really is a debt agreement. So in that situation, when the PPP loan was received, you would record the full amount as a liability. As it goes through, you are accruing interest and recording that accrual. And then the uniqueness for PPP loans obviously comes with the fact that it can be forgiven. And hopefully any of you who have PPP loans out there do get full forgiveness. If you account for it as a debt, then you would record a gain on extinguishment once it's forgiven. And we will talk about specific accounting and presentation for that gain here in a second. If it is not forgiven or is only partially forgiven, then any remaining liability would be just treated as any other debt and would be reduced as it is repaid in accordance with the terms. The other option is to treat this as a government grant. And so with the clarified accounting guidance for determining the difference between contributions versus exchange transactions, that would mean that these are treated as a conditional contribution, since there is that right of return if it's not forgiven. So if you go the route of treating it as a grant or a conditional contribution, similar to any other conditional contributions, at issuance, you would record the liability, which is really that refundable advance. And then as the conditions are substantially met, you would record that grant revenue. And so in the case of a PPP loan, really those conditions are use for eligible payroll costs or mortgage interest payments, rents, utilities, in accordance with the terms of the program over the 8 or 24-week period, depending on what you chose. So assuming you're using and those conditions are substantially met, you would recognize that revenue. In the case where you're able to recognize everything, there would be no journal entry upon forgiveness because there would be no remaining liability. But in the case where the loan would not be forgiven or you're unable to recognize the full amount of the revenue, then any remaining amount not forgiven would need to be reclassified to debt and you'd be back into normal debt accounting. So for that gain on extinguishment, if you elect to account for it as debt, this would follow the accounting standards relating to any other debt agreement and what to account for when it is partially forgiven or extinguished. And so you would need to present that gain on extinguishment as a separate line item on the statement of activities. And if you elect to disaggregate your statement of activities between operating and non-operating activities, this gain would need to be classified as non-operating. On the statement of cash flows, this would be reflected as a non-cash adjustment from change in net assets to the cash flows from operating activities. So we have an example of what that cash flow statement might look like. This assumes that the PPP loan is received and forgiven in the same reporting period. So you can see that it's a little bit unique that you would be showing a $100,000 issuance of debt in your financing cash flows as a receipt, and then the operating cash flows would net to zero as the $100,000, in this case, gain on extinguishment would be offset by that non-cash adjustment. As far as timing goes, the forgiveness and the gain on extinguishment should be recorded in the period in which it is legally released. And in this situation, that legal release is really when the SBA determines that it is forgiven. Obviously from the time you submit your forgiveness application, there are 60 days for lenders to make a decision, and then an additional 90 days for the SBA to make their final decision. So you would need to wait until that SBA decision. And so there could be situations that you might run into where the forgiveness occurs after your balance sheet date. If that's the case, then you would, the forgiveness would be in a separate period, and also would need to consider subsequent events if the forgiveness is official before the financial statements are released. All right, so with that, would like to take a quick pulse with our question number 2 here.
All right, so our second polling question is, what stage of the PPP loan forgiveness application process is your organization in? A, did not take out a PPP loan. B, not yet submitted loan forgiveness application. C, submitted loan forgiveness application to lender, did not receive their decision yet. D, submitted loan forgiveness application to lender, received their decision. Or E, received decision from SBA. And just as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And it looks like we almost have most of the people responding, so we'll give it another moment here.
Hopefully everybody gets to answer E. I think anecdotally, at least talking to some of my clients, it sounds like still waiting for SBA final decisions. I have received a couple emails over the past week or so saying that people have actually received that final decision from SBA. So that is always an exciting email to get.
Okay, here you go.
All right, so it looks like about half of you did not take out a PPP loan, and the rest are in some stage of working on the forgiveness application or waiting to hear back some decisions. So for those of you waiting, good luck to you all, and hopefully it is not a tedious process for you. And with that, I think I will turn it over to Sasha.
Thanks, Adam. So we're going to continue with the COVID-19 focus for a little bit more, and actually for the majority of our discussion today. But now we're going to take a shift away from PPP loans and talk a little bit more about treatment of specific federal funding as it pertains to the schedule of expenditures of federal awards and a few other accounting considerations. Under the Coronavirus Aid, Relief, and Economic Security Act, as we'll refer to as the CARES Act for the rest of our presentation, multiple federal agencies issued relief funds. Federal agencies are required to specifically identify COVID-19 awards for the recipients. It should be noted that identification as COVID-19 funds is required whether it's funded from an existing program or it's a new program. Thus, it's very important to identify what portions are COVID-related and what portions might not be, if funded under an existing program. This identification is important for proper CIFA presentation, as well as will likely have an impact on what compliance requirements are applicable and the related auditing of those requirements. There can also be challenges in determining whether there was an actual award that was received. A few things to make note of. The typical award process is not being followed due to the pandemic environment. There also may or may not be an actual signed award document. A few things to consider when evaluating whether your organization has received Federal CARES Act aid. One last item of note, if your organization is then sub-awarding these COVID-19 funds, it's equally as important that you distinguish incremental COVID-19 funds from non-COVID-19 subawards for your recipients. On the next slide, we will show what this might look like on your CIFA. Here is an example of what this might look like. You will see that this organization received funding from Program 93.558, both COVID-related and non-COVID related. Even though both grants carry the same CFDA number, and in this case, let's assume both are direct, the separate pieces for COVID-19 funds and non-COVID-19 funds need to be called out and shown as separate line items, with then a total for the full CFDA number. This distinction will also flow through to the presentation on the data collection form, whereby the identification of COVID-19 funds will be shown in the additional award identification column on the form, and then also in the federal program name column, which then will tie directly back to your CIFA. Next, let's talk a bit about when the COVID-19 funding expenditures should be included on the CIFA. Many of you have probably already experienced that receipts of the new COVID-19 funds are introducing new challenges to your normal processes. Your organization may have received cash well before the award or related terms were agreed to. There is this new concept of receiving funds for lost revenue. And what exactly does that mean? Your organization may have a more flexible opportunity to choose which costs are charged to a particular award at levels we have never seen before. The general rule of thumb to follow for CIFA inclusion includes whether the underlying activity has occurred. Are there award or terms of conditions? And they may not necessarily be tied directly to your GAAP revenue recognition. Documentation will be key for the organization in tracking and identifying the proper amounts. An important thing to remember is that COVID-19 funding received for the current year may not be above the Type A threshold for this year. However, it's very likely that it will jump over the threshold, if it didn't already in 2020, in fiscal year 2021. So be on the lookout for major programs to increase in fiscal year 2021. For those where it is a major program for fiscal year 2020, the fact that the addendum to the 2020 compliance supplement has not been released yet is definitely holding up the issuance of single audit reporting packages. Adam will talk briefly about the status of that addendum here in a few moments. Continuing on, let's talk about relief funds and take a minute to go over a few specifics of one of the larger areas of the funding, the Higher Education Emergency Relief Funds for universities. The CARES Act allocated approximately $14 billion of funds to higher education institutions. Under this relief funding, there are two main components, the student portion and the institutional portion. Participating institutions must sign two agreements. one for the students and one for the institution part of the funding. Under the legislation, no less than 50% of the full grant must be used for direct emergency aid to students, including but not limited to grants to students for food, housing, course materials, technology, healthcare, and childcare. The recipient, being the university, agrees to promptly make available emergency financial aid grants from the advanced funds to the university directly to the student. When the cash is received by the university, the credit or offset is to a deferred or refundable advanced account. The grant revenue is then recognized as the student aid expenses are incurred. For example, the funds are being dispersed. While many universities have recognized revenue for this as of June 30, 2020, it is anticipated that many will still continue to recognize more of this funding as revenue in fiscal year 2021. For institutional aid, the remaining portion, up to 50% of the full grant, should be used by institutions to cover costs associated with significant changes to the delivery of instruction due to the coronavirus. Funds can be spent only on those costs for which there is a clear nexus to instruction delivery changes due to the coronavirus. Institutions can use funds as reimbursement for foregone revenue caused by campus closures and the necessary move to online instruction. Foregone revenue results from refunds made to students for housing, food, or other services that can no longer be provided as a result of coronavirus closures. Grant funds cannot be used for endowments, athletic or religious facilities, and enrollment recruitment activities such as marketing and advertising, or to compensate recruitment contractors. Additionally, expenditures for senior administration or executive salaries, related benefits, incentives, or other items specified in contracts would not be considered qualifying costs. The legislation also requires that institutions that receive the funding must retain their current employees to the maximum extent practicable. When recording the institutional portion of the aid, when cash is received, universities will then record a credit or offset to deferred or refundable advance accounts. As the barriers or eligibility criteria are satisfied, revenue is recognized. Similar to the student portion, many universities recognize revenue for this portion in fiscal year 2020. However, it's expected that more will continue to be recognized in fiscal year 2021. One thing to specifically consider with the HEERF aid is ASU 2018-08. Per ASU 2018-08, grants are conditional when both a right of return and a barrier to entitlement exist. Thus, under ASU 2018-08, HEERF aid is considered a conditional contribution. The HEERF grant is conditional because grant certification agreements limit the university's discretion over how the assets can be spent. Student portion contains specific requirements to provide emergency to students with financial needs. The institutional portion requires that there be a clear nexus of either expenses or expenditures, or in this case, foregone revenue, to coronavirus disruption, and there are also specific types of expense exclusions. Remember that each portion of the HEERF funding, the student and the institutional, is reported separately on your CFA as separate line items. Okay, Adam, I'm going to kick it back over to you so that you can talk about the compliance supplement addendum.
Absolutely. So that was talking through the accounting considerations from your all side. Do want to take a brief moment to talk about the audit considerations from the auditor's side. And unfortunately, this is one of the biggest areas of uncertainty and frustration for a lot of organizations and for a lot of accounting firms as well. As auditors, we are required to perform our audit procedures for major programs in accordance with the compliance supplement that's issued annually from the Office of Management and Budget. And when the 2020 compliance supplement was issued, it didn't include guidance for certain COVID-related programs. The intention then was to issue a separate addendum covering those programs, but that has yet to be issued. On the slide is those programs that are anticipated to be covered in the addendum once issued, with the bolded ones being some of the more common ones we're seeing. Sasha talked through the Education Stabilization Fund. That'd be the HEERF funds for a lot of higher education institutions, and then a lot of hospitals are getting the Provider Relief Program funds. So without the addendum and without the audit instructions contained within the addendum, auditor hands really are tied for issuing single audit reports at this point. Really, we would need those to be able to determine what procedures to perform over major programs, and in some cases, even being able to determine if programs are major programs requiring audit procedures. There was a draft of the addendum that was issued earlier this year, and the AICPA's Government Audit Quality Center did issue a response to that draft at the end of September. In that response, it expressed a number of concerns with the draft as written. One of the biggest concerns was actually with that provider relief program. Sasha mentioned the concept of lost revenue. That was one of the bigger issues, that there's a need for specific guidance on how to calculate lost revenue, what periods to look at when determining the amount of lost revenue. And in no uncertain terms, the GAQC said that the provider relief program was not workable in its current form. So the government has been going back and trying to address those. There was some initial hope that the final version would be issued here in late November. Obviously, we are into early December at this point, and there hasn't been anything issued yet. So what does that mean for you? Many of you have already faced or may be facing delays in issuance of your single audit reports, which obviously is frustrating on your all side. The GAQC has advocated and does continue to advocate for an extension of the reporting requirements for single audits to help ease any burden there. As it stands, any 6/30/2020 year ends would need to file their single audit reports by March 31st of 2021, which obviously could pose some problems if the addendum isn't issued until here into the new year. So at this point, really, our best recommendation is follow the current guidance that's been issued by the agencies, look at their FAQs, try to document as much as you can for right now, and do keep an open line of communication to auditors. The one silver lining with all this is that all organizations are going to be in the same boat. So hopefully your regulators and your users of financial statements understand this and expect this. So hopefully there shouldn't be any issues there. And if you run into the case where you do need financial statements for bond covenant purposes or any other reason, there are options to issue the financial statements themselves on time, with the full single audit report coming later. And if that's the situation you run into, definitely recommend discussing that with your auditors. So for those of you who don't have federal funding, we will talk about something that will be applicable to pretty much any organization filing financial statements, and that is the impact to disclosures related to COVID-19. There are a number of new considerations and new disclosures that might need to be included in your financial statements. One of the biggest areas of concern, and one of the most unfortunate things, is that a lot of organizations are in a situation where the totality of events and circumstances raise substantial doubt that they will be able to continue operations for a period of 12 months from issuance of their financial statements. So with that, that requires some additional going concern disclosures, potentially an emphasis of matter paragraph within your audit opinions. But again, just given the economic environment that we're in, that is something that we are seeing increase in prevalence. Additionally to that, there's going to be situations where estimates are changing. Thinking through the economic impact, that can impact estimates of fair value of assets, that can impact collectability of accounts receivable, that could potentially impact useful lives of fixed assets in certain circumstances. And any significant change in accounting estimates should be disclosed in the financial statements. And regardless of what year you're in, any significant risks and uncertainties do need to be disclosed in the financial statements. And if there's one adjective that I have heard used to describe 2020 and COVID, it is uncertain. And so there is an expectation that in pretty much any financial statement, there is some discussion of the uncertainty related to COVID. How does that impact your organization, and how might that continue to impact your organization going forward, and what are the uncertainties related to that? And then lastly, just thinking through, again, subsequent events, given that there's a lot of changes and a lot of adjustments and just fluctuations in operations, really thinking through what subsequent events need to be disclosed, and thinking through all of this as far as just what information would be useful to the users of your financial statements, and trying to paint that picture for them within the notes to the financial statements. All right, we will toss it back over to Sasha for a couple other considerations here.
Well, thanks, Adam. Yeah, we're going to stay in this current COVID world discussion a little bit longer with a few other topics, although I think we all kind of wish we were done living in this COVID world, and hopefully we're getting there soon, but we'll be talking about it for a while. And kind of to elaborate on a few things that Adam just talked about, but we continue to see more in the current environment, is the need for impairment considerations. Given the current economic and business environment, many more assets may be impaired related to prior periods. And this requires additional consideration in the current year by both management and also by the auditors, as the auditors are looking at them. On this slide, we highlight a few. Receivables and those related to long-lived assets with finite lives, your PP&E or intangible assets. Other key areas that could need consideration that we will not be discussing specifically today would be inventory and goodwill. With receivables, the risk would be that donors will no longer be able to come due on their promises, or that they have been altered, maybe a change in payment plans. While many believe the donor base is strong, and this likely is true, many donors are still experiencing changes in personal financial positions that could have a rolling impact to organizations. You may start to see that donors are late on payments, and that donors are communicating a need to revise their certain plans. You want to evaluate for additional specific reserves that may be necessary in the current year as a result. Remind yourselves that reserves for receivables can subsequently be reversed if facts or circumstances do change. However, actual write-offs of receivable losses cannot be subsequently reversed. Remember to include necessary disclosures, including your reserve policy and information about the activity and the allowance for doubtful accounts. The impairment consideration for receivables should be evaluated on an annual basis each time the financial statements are issued. For PPE, that's property, plant, and equipment, I confuse myself sometimes these days because PPE refers to personal protective equipment, and I never thought that that would become a common acronym in my vocabulary as an auditor, but it has, given our COVID world. So for your property, plant, and equipment, and also your finite-lived intangible assets, you'll want to evaluate for impairment of individual assets or asset groups of like kind. Your step one will be to calculate whether undiscounted cash flows are greater than the carrying value of the asset or group. And if so, then there is no impairment, then you can move on. If they are less, then you have possible impairment and you'll move to step 2. Under step 2, if the fair value of the asset or group is less than the carrying value, then you have an impairment loss. Impairment losses on long-lived, finite-lived assets cannot be subsequently reversed. There are separate procedures for long-lived assets held for sale, as a reminder. Additionally, there are a number of disclosures required about the nature of the impairment loss and how and where that impairment loss is recognized and measured. The key message from this slide is to be alert and aware of the impact on your assets of the current pandemic situation. We are all dealing with issues that may not be routine, and it's important to evaluate and consider them all as part of your financial reporting responsibilities. You can likely plan on additional questions related to this from boards, committees, as well as your auditors. How organizations navigate these unprecedented times? There are some key considerations for audit committees to consider when executing financial reporting responsibilities and working to ensure audit and financial reporting quality. We encourage management to ensure you are having these discussions with the appropriate individuals of those charged with governance. Financial reporting. Review the work environment as it relates to work from home and virtual. Are there gaps and are processes documented? Business conditions. What are the financial impacts? Consider operations, valuations, and related impairments, allowances, and changes to estimates. Demand for services. Are contracts and revenue streams impacted, and has management communicated the impact on long-term projections? Liquidity. Has management assessed impact on financing arrangements, including debt covenants, and have the related accounting and disclosure requirements been considered? CARES Act funding. What are the financial reporting consequences, and what are the ongoing monitoring and reporting requirements? Lastly, technological changes. How are you protecting the organization from cyber attacks? And is current technology adequate to support remote work environments and also your organization's security? These are the main categories to consider. In order to address these risk areas, we have developed a specific checklist based on 15 questions your audit committees should be asking. In addition to the 15 questions, the checklist also includes follow-up inquiries you should be asking as management. The link is at the bottom of this slide, which will be subsequently made available to attendees. One thing I believe we all quickly realized as we moved into this pandemic reality was how important IT is to the functionality of the organization and also how far-reaching it can be in terms of risk. On these next 2 slides, we've put together a few key considerations for your organization to consider to help assess and also mitigate IT risk. First, what, if any, staff reductions were performed? As part of those reductions, what procedures were taken for offboarding, and were any staff in sensitive roles or assignments? Does the organization have a process to evaluate new, changed, or terminated access rights? Next, what about any direct IT service providers? If the organization is using direct IT service providers, how do these providers connect to the organization's infrastructure? And has management discussed COVID-19 changes with the service provider, if any, or the need for such changes? Is the organization using a VPN or some other form of authentication for its employees and service providers? And is the organization able to monitor who is connected to the infrastructure and when and what type of monitoring is in place to identify any unwanted connection attempts? And lastly, to consider, Have there been any delays in strategy, or have annual procedures been deferred? What risks might this pose? These are just a few questions you can ask to start the discussion on IT risk within your organization. We think these are key considerations from an IT perspective that should be considered in an attempt to identify and mitigate risk to the organization as we continue to live and probably for the foreseeable future be in this remote and virtual environment. I think Adam's going to dive into the FASB update.
Yeah, I feel like we've probably had enough COVID here for the day. And so with the rest of our time, we will talk through some of the new accounting standards that will be impacting your organizations here shortly, and those that have been issued recently. We will start, and I guess before I dive in, I will say that the FASB has been understanding of everything that you all are facing this year. And so there really haven't been a ton of new standards issued, and a lot of the ones are actually helping to ease administrative burden. And so the first two I'll talk through are actually good news accounting standard updates, which I don't think we can always say that's the case. The first one is the biggest good news, and that is ASU 2020-05. And this delayed the effective date for two of the more significant accounting standards to be implemented. And that is the new revenue recognition standards under 606 and the new lease standards under 842. So for any entities that had not issued their financial statements before COVID hit and before ASU 2020-05 was issued, there was an extension for the applicability of revenue recognition that would now be effective for annual reporting periods beginning after December 15, 2019, or to put it in simpler terms than FASB likes to use, that would be your calendar 2020s. So any of you who have 12/31 year ends, your 2020 financial statements would need to include consideration of adoption of 606. For 842, there was a 1-year extension for not-for-profits with public debt and an additional 2-year extension for everyone else. So not-for-profits with public debt, the new lease standards would be effective here for calendar 2020 or fiscal 2021s. And then all other not-for-profits that don't have public debt, you have a couple more years before this is going to be effective. And so hopefully that's a little bit of a stay of execution, and working through that. The new lease standard is an onerous one to implement depending on the number of contracts and leases that you have. So there is some good news that came out of 2020 here. We will move on to our polling question number 3 here then. Amy?
All right, thank you. So our third polling question, when will your organization adopt topic 842, leases? A, already adopted. B, we're on track to adopt this year and will still do so. C, when required, the later the better. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending the slides out tomorrow via email along with a recording of our webcast. And we'll give everyone another moment to respond.
While you guys are responding, I'll just share a quick anecdote. So was working with a client that has a 9/30 year end. They were on track to adopt ASC 842 with the new lease standards. They elected to do so, and their lease footnote is 4 pages long. So there's some excitement for those of you with a lot of leases to look forward to, as even longer financial statements.
All right, well, here are the results.
All right, it looks like the strong majority are in the later the better. I like that attitude. That is, if I that's where I would fit in myself. All right, moving on. The next accounting standard that we wanted to talk through is ASU 2018-13. This is related to fair value measurements. So any of you with investments or other assets that are carried or measured at fair value, this will impact your financial statements disclosures. This is another good news ASU in that it is simplifying and removing disclosure requirements. So it does remove certain disclosure requirements. You no longer have to disclose the amount and reasons for any transfers between level 1 and level 2. You do not have to disclose your policy for when transfers are recognized. And for any level 3 fair value measurements, you no longer have to disclose the evaluation process or changes in unrealized gains and losses related to those. It modified a couple additional disclosure requirements. Again, for level 3, historically, you were required to include a full roll forward of all of the activity. That is simplified. You don't have to include the full roll forward. You just need to disclose transfers in and out, purchases, and issuances. And then for those of you who have investments that are measured using the net asset value NAV practical expedient, you don't have to disclose timing of liquidation or timing of when restrictions from redemption might lapse unless those are communicated to you or publicly announced. So that really eliminates the burden of trying to hunt down your contacts and get the information necessary for disclosures. If they're not communicating that to you or the public, you don't have to disclose. And this would be effective for fiscal years beginning after December 15th, 2019. So again, that would be your calendar year ends for 2020 or fiscal year ends for 2021. Moving on to a couple that are specific to the NFP industry. The first one is a change to the definition of what a collection is. And the change is really in that third bullet point. Historically, collections were restricted to those where the proceeds from sale of collections were required to be used to purchase new collections. That has now been expanded, and it considers cases where the use of proceeds can be used for direct care of existing collections. So if you're in a situation where you have collections, but you use the proceeds from sale to help maintain and care for the remaining collections, that now meets the GAAP definition, and you would need to include certain disclosures within your financial statements. With the change in definition, it did also change those disclosure requirements. So now entities are required to disclose the policy for what they can use proceeds for. So again, can they be used for purchases of new items, direct care of existing items, or a combination of both? And if you allow proceeds to be used for direct care, you would need to disclose the definition of direct care in the financial statements. And again, this is for fiscal years beginning after 12/15/19, so calendar 2020s, fiscal 2021s. All right, and the last one we'll talk through is the one that will probably have the most significance or most significant impact to a lot of organizations, and that deals with contributed non-financial assets. So that is really your in-kind contributions, your donations of assets or services. And so this now requires that on the statement of activities, contributed non-financial assets need to be presented in a separate line item. So you can't just include that in the general collections or in the general contributions line item. It would need to be separated into its own. And then with that, there is an increase in disclosure requirements. And if you think we're limited to just what's shown on this slide, I've got another slide full of new disclosure requirements for you. So within the disclosure requirements, would need to disaggregate that financial statement line item of contributed non-financial assets by type. of assets. So that could be buildings, that could be inventory, that could be services, but breaking out and disaggregating the amount by type. Then for each type or each category, there are a number of disclosures to be included. The first is some qualitative information about whether those are monetized or sold, or if they're just utilized within the reporting period. There is a requirement to disclose the policy of whether those non-financial assets, again, by category, can be monetized or utilized. If there are any donor-imposed restrictions associated with the contributed assets, would need to disclose that. For each category, disclosing the evaluation techniques and inputs and how you're determining the fair value and that amount that you're recognizing. And then the last one there is a unique situation where if the principal market that you're using to determine the fair value, if donors donate assets but restrict or prohibit you from selling or using those assets in that market used to determine the fair value, requirement to disclose that market. So it's a weird one. An example would be if you had someone donate PPP, and this time we're talking personal protective equipment. So they donate PPP supplies, but say you have to use these in third world countries, but you're using US market to value, that would be the situation that you'd fall into for this one. Since this one's a little bit higher impact, there's some additional time before it's required to be implemented. It is effective for fiscal years beginning after June 15th, 2021. So any 6/30 year ends, it would be your fiscal 2022. And it does need to be applied retrospectively, so adjusting previously comparative periods for this standard as well. All right, we are on to our last polling question of the day here.
Okay, so our last question, of the accounting standards just discussed, which do you think will be the most challenging to implement for your organization? And you have the options A, B, C, D, and E below. So select the one that would be the most challenging and then hit submit. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And we'll give everyone a few moments to respond here. Make sure you all get your CPE. Okay, here are the results.
All right, so unsurprisingly, revenue recognition and leases continue to be the biggest areas of concern, and it seems pretty spread out between all of them. So for all of those, there's definitely resources, and we'll talk about some resources at the end to help you with all that. But for the remaining of the time, I will turn it back over to Sasha to talk about a couple other changes that might impact your reporting.
Thanks, Adam. Great job on that FASB update. It was kind of refreshing to follow all of that COVID discussion. It's nice to get a break from all of that. So who would have ever thought we would have thought a quick little FASB update would clear our minds from everything else going on in our world. So thank you. I'm here to take us across the finish line. A few more slides to get through as part of today's presentation, and then we'll send you all on your way. Let's talk for a minute about the financial responsibility ratio reporting. Many of you with June 30 year end have already dealt with the addition of the financial responsibility ratio reporting as part of your audit or are currently dealing with it right now. This is a required schedule that is separate from your CEPA and is included as part of the notes to the CEPA. It's required to show the calculation of your composite score in order to reduce ambiguity or difficulty in the Department of Ed calculating the score. The reporting must include all financial elements needed to calculate the composite score ratios and must cross-reference to financial statement line or note disclosure line items containing that element. As a result, inclusion of this schedule may require changes to the financial statements or notes so that every item needed in the composite score calculation can be directly tied to the financial statement. Here are a few examples that have been pulled from the Federal Audit Clearinghouse. As you can see, there is no one set prescribed format. The key element, as mentioned on the prior slide, is that all of these elements must directly tie back to the financial statements or those note disclosures. The example on the left is more in line with what is shown in the CFR, and the one on the right is a more simplified version, but both are considered acceptable. Okay, the last item we just briefly wanted to bring to your attention before closing out today's session relates to the auditor reporting changes that are coming down the pipeline as a result of SAS 134. Auditor reporting and amendments, including amendments addressing disclosures in the audit of financial statements. SAS 134 revises the auditor reporting and works to enhance the relevance and usefulness of the auditor's reports. This is the first major change we have seen in many years, and the predominant change is to move the opinion paragraph to the front of the auditor's report. This change will impact all audit reports for periods ending on or after December 15th, 2020. So be on the lookout for that revision and don't be surprised, or maybe remind your boards and audit committees to not be surprised when the audit report does look slightly different from what you had experienced for many years. It is a planned revision and don't want anyone to feel alarmed by the change in the presentation. I think that pretty much wraps up our presentation for today. I know we had planned to have some Q&A, but Amy, I think you might have a minute or two of wrap up to go over, and we may need to follow up with some of the great questions we have received offline. I'll turn it over to you, Amy, to kind of wrap things up.
All right, thank you. And thank you, Sasha and Adam, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. And before you go, I'd like to invite you to our Fall Tax Update webcast, which we're hosting this Thursday, December 10th at 10 a.m. Pacific Standard Time. A link to the registration page is in your console. And for more resources, please visit our website where you'll find links to our COVID-19 resources, not-for-profit newsletter, and other insights and resources. We've included links in today's presentation, which you can download via the slide deck and handouts window to the left of the slide view. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining our webcast. We hope you'll join us again next time.